Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. This week sees the return of US earnings season. On this occasion, we're looking at the fourth quarter of 2023. And certainly traders will know that the end of last year was a particularly bullish one for markets, a strong upside move for US equities in particular, born out of the idea that we're going to see the Federal Reserve enact a potential 6 rate cuts over the course of this year, kicking off in March. Whether that comes to fruition or not remains to be seen, but certainly markets are looking for justification for the levels that we're seeing in terms of equity markets, and question marks are abound given the fact that there is a big disparity between what markets are expecting and what the Federal Reserve is expecting from a monetary policy standpoint. With that in mind, there's a good chance that as we move through the coming weeks, earnings are going to be a big focus for markets, and it's going to be one of the core drivers behind market sentiment. So it's worth looking ahead to it and understanding exactly what we're looking out for in the coming weeks and months. Breaking down a number of different factors, I wanted to show you some things. Many of these have come from the FactSet preview that they come out of a whole raft of data that's particularly interesting and important. It's worth looking back first and foremost to that third quarter. And certainly there's been a big disparity in terms of outperformance on the earnings front and the revenue front. So earnings, we have by and large seen outperformance near enough across the board. You can see that even the worst performing of the lot was the real estate sector, and that saw roughly 70% of firms outperforming expectations on an earnings front. So we've seen companies doing particularly well on earnings. That hasn't necessarily been the case in terms of revenues. Revenues, a lot more of a mixed bag in terms of companies managing to beat expectations. And bear in mind, there's often a sort of allegation leveraged at companies that they essentially try to massage down expectations closer to the release with a view to being able to beat expectations. Well, that has been successful in terms of earnings, less so in terms of revenues. In terms of a breakdown of these different sectors and seeing which have actually seen sort of very substantial earnings surprise percentages, consumer discretionary and communication services, two of the big gainers. Consumer discretionary, very pro-cyclical. This highlights the strength within US consumers that had perhaps not necessarily been expected by markets. And that's going to be particularly key as we look forward to this earnings report, because of course the fourth quarter has the likes of Black Friday, Cyber Monday, the Christmas sales. And so demand around this time of year is going to be absolutely key. Last time around, we saw consumer discretionary companies outperform expectations. Can we see the same? Well, certainly that's going to be a big driver of sentiment from the economy as a whole, because of course, domestic consumption is a big driver of growth. In terms of markets reactions that we've seen in the third quarter to different upside or downside surprises, what we have seen, which is traditional, is that downside movements have been larger than upside movements. So beat on expectations in terms of earnings have given you a decent move towards the upside, but underperformance has really given you that outsized move. So this was particularly pronounced in the third quarter. We can see here 4.4% is the average downside move when we see a negative surprise in terms of earnings. So certainly if we're looking for volatility, by and large, it's likely to come towards the downside. And certainly that is likely to ring true in the fourth quarter, because bear in mind, we've of course seen equity markets really strong into the back end of last year, now starting to come off because we're seeing some questions arise over, yes, around what's happening in terms of monetary policy and whether there's a justification to expect the Federal Reserve to cut interest rates 6 times starting in March, given where inflation is, given where the economy is. But also question marks about these new valuations for a number of these stocks as we've seen them gain ground. Are they justified? Well, we need to see earnings improve and strengthen to justify us to continue to move towards the upside. And if we don't see that justification, you're likely to see a significant downside move, as we've seen just there. In terms of the relationship between equity markets and earnings, you can see here, we do see this 12-month forward EPS largely tracking alongside price action for stocks. Now, you'll see that of late, stocks are getting ahead of that EPS line, which is the black line, the forward 12-month EPS. That really points towards growing expectations of growth as we move forward. So there's confidence within the market at the moment that we are going to see these companies outperform and grow moving forward. Certainly the AI boom has helped that. But bear in mind, this is a forward 12-month EPS. So what are expectations of growth in terms of earnings over the coming year? And certainly that points towards the importance of forecasts in terms of these companies. Where are they looking for earnings to be in a year's time? So the strength of the business in the fourth quarter is important, but what's the outlook? So keep an eye out for the outlook from these companies. That's going to be particularly important, because if they expect to see strong earnings growth next year, then that helps justify further upside in terms of the share price. A good graphic that I've found here really shows you the breakdown in terms of the last 4 years and what has been a major driver of that. You can see in 2021, it has been earnings growth. And then certainly for last year, 2023, we've been seeing multiple growth. So people willing to attach a higher multiple to the share price. That often happens in anticipation of that earnings growth. And we need to see that earnings growth come through soon enough. You can't necessarily just see year upon year upon year of multiple growth and not those years of earnings growth. And there is a hope that this year we can see these companies really start to push forward in terms of earnings, and we see the economy coming back into strength, hopefully, as we see confidence return and monetary policy start to loosen somewhat. So is this going to be a year that is dominated by earnings growth? Or is it going to be another year where the economy is somewhat floundering, trying to recover after a period of elevated interest rates, and we continue to just try to sort of expect a strong period ahead in terms of earnings, and therefore we just see improved multiples? That sort of move in terms of improved multiples only has a limited time span, because of course they can only get stretched so far before people think there's no value in these stocks anymore. So certainly earnings are going to be a particularly interesting point of growth, hopefully, for the coming year. And so this really highlights the likely importance of earnings coming into 2024. In terms of the different segments that have sort of buy, hold, or sell ratings, I thought I'd show you sort of where are the hot markets at the moment. You can see energy, interestingly, has a significant amount, of the highest amount of buy ratings within it, around about 64%. Then communication, services, healthcare. And certainly that's important, the energy side of things, because markets are expecting energy to suffer, and we'll show you exactly that. So this is the breakdown in terms of the outlook for the fourth quarter in terms of year-on-year performance. Once again, it's energy that's expected to see the big slump, because we have seen crude prices and gas prices move lower over the back end of last year and the second half of last year. It was the case in Q3. It's a case once again, energy materials expected to really deteriorate in the back end of the last year. And in terms of strength, communication services, as I highlighted previously, utilities, and again, consumer discretionaries. So those pro-cyclical sort of retailers, are we going to see the consumer come through once again? Well, we have got high expectations this time around in terms of those sectors. And then finally, I wanted to show you things from a revenue perspective. Once again, energy, materials, both expected to see significant declines, but this is really born out of the value of their underlying sort of product. And then on the upside, we're expecting to see strong revenues from the likes of the financials, IT, real estate. Certainly financials is going to be a particularly interesting one. As I highlighted, we've got the US banks kicking things off on Friday. And the fact of the matter is that they have been preparing for a potential hard landing in the US that apparently, or seems to have not come, and there's a good chance that it won't come. If we do see this soft landing, are we going to see these businesses really strengthen off the idea that they're going to take some of those bad loans off the balance sheet and be able to look forward to a period where they see relatively elevated margins and an economy that still holds up relatively well? So certainly going to be a particularly interesting time, but very notable the fact that we're seeing energy expected to underperform and see significant negative growth on both revenues, earnings. Yet that's the segment where we see significant buy ratings for going forward. Is this an area where people will see it as a buying opportunity? Certainly, a lot of it is going to come down to the outlook in terms of oil and gas demand moving forward, and whether the likes of China is going to be able to buck up its idea and move back into a healthier economic position after a period that has been particularly difficult for the world's second largest economy.